Preparing for a Business Development Bank of Canada interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about BDC, and why do you want to work here? BDC is Canada's federal business development bank, focused exclusively on entrepreneurs and small and medium-sized businesses. I am attracted to its combination of commercial discipline and public mandate, financing viable companies, supporting innovation, and strengthening Canada's economy. The role also appeals because decisions require judgment, relationship skills, and risk awareness. I would bring analytical rigor, curiosity, and a genuine interest in helping businesses turn capital into sustainable growth. While answering, focus on BDC's federal development mandate, exclusive focus on entrepreneurs and SMEs, commercial discipline, economic impact, and how your skills connect with relationship management, analysis, and responsible financing. Question 2. How is BDC different from a traditional commercial bank? The key difference is BDC's dual purpose. A commercial bank primarily optimizes risk-adjusted returns within its lending criteria, while BDC also aims to strengthen Canadian entrepreneurship and fill financing gaps. That can mean providing longer-term capital, venture financing, or advisory support when a business is promising but not conventionally bankable. BDC still underwrites risk carefully. The development mandate does not eliminate commercial accountability. It broadens the situations where disciplined capital can create economic value. Make sure to cover BDC's development mandate, patient and specialized capital, underserved businesses, advisory support, risk-adjusted returns, and the fact that BDC complements rather than simply replaces private sector lenders. Question 3. What products and services does BDC offer to entrepreneurs? BDC offers more than one financing product. Its solutions include business loans for equipment, expansion, or working capital, growth and subordinated financing, venture capital for high-potential companies, and advisory services. I would begin with the entrepreneur's objective and cash flow profile, then match the instrument to the need. For example, equipment may suit a term loan, while rapid expansion could require patient growth capital. The right solution should support growth without creating an unsustainable repayment burden. In your answer, discuss term loans, working capital financing, growth capital, venture capital, subordinated debt, advisory services, and how solutions should be matched to business stage, purpose, risk, and repayment capacity. Question 4. How would you assess an SME seeking financing from BDC? I would assess the business through 5 lenses: management, market, financial performance, requested purpose, and downside risk. I would understand how the company makes money, test the durability of demand, review margins and cash conversion, and reconcile projections to historical results. Then I would evaluate leverage, collateral, liquidity, and repayment capacity under stress. Finally, I would determine whether the financing solves a productive need and whether the structure gives the entrepreneur room to execute. Be sure to mention management quality, business model, market position, historical and projected cash flow, leverage, collateral, repayment capacity, industry risk, and the purpose and proportionality of requested financing. Question 5. Which financial metrics matter most when underwriting an SME loan? I would prioritize recurring operating cash flow and debt service coverage because repayment ultimately comes from cash generation. I would also review EBITDA margins, leverage, liquidity, working capital needs, receivables aging, customer concentration, and revenue trends. A healthy ratio today can be misleading if cash is tied up in inventory or one customer drives most sales. I would compare metrics with industry norms and investigate unusual movements, then build a downside case before recommending terms. Focus on recurring EBITDA, operating cash flow, debt service coverage, leverage, liquidity, working capital efficiency, customer concentration, and trends rather than relying on one ratio without understanding the underlying business. Question 6. How would you analyze a company with strong revenue growth but negative cash flow? Negative cash flow is not automatically unacceptable, especially for a growing company, but I would identify why it exists. I would separate investment in productive growth from weak unit economics, examine gross margins, customer acquisition costs, retention, working capital requirements, and cash runway. Then I would test whether management has a credible path to positive cash generation. Financing may be appropriate if growth is efficient and milestones are clear, otherwise, additional debt could amplify the problem. Mention growth quality, unit economics, gross margins, customer acquisition, working capital investment, cash runway, funding requirements, path to profitability, and whether financing supports sustainable expansion rather than postponing a liquidity problem. Question 7. What is debt service coverage ratio, and why is it important for BDC? Debt service coverage ratio measures the cash available to meet required principal and interest payments. A stronger DSCR indicates greater repayment capacity, while a weak ratio signals dependence on refinancing, asset sales, or optimistic assumptions. I would calculate it using normalized cash flow, not blindly accept reported EBITDA, and test it under lower revenue or margin scenarios. At BDC, that discipline matters because supporting entrepreneurs requires sustainable structures, not merely approving financing that works in an upside case. Explain DSCR as cash available for debt service divided by required debt service, discuss repayment capacity and sensitivity analysis, and clarify why historical and projected DSCR can tell different risk stories. Question 8. How would you evaluate the management team of a small business? For a small business, management quality can outweigh a polished spreadsheet. I would assess the team's industry knowledge, execution history, integrity, financial understanding, and ability to adapt. I would ask how they made difficult decisions, handled setbacks, retained employees, and monitored performance. I would also look for succession depth and honest recognition of weaknesses. Strong leaders do not need every answer, but they should know their numbers, seek expertise early, and follow through on commitments. Cover integrity, relevant experience, strategic clarity, execution history, financial literacy, succession depth, communication, adaptability, and evidence that management recognizes weaknesses and has credible plans to address them. Question 9. A BDC client wants to expand into a new market. How would you assess the opportunity? I would first distinguish attractive demand from an attractive, executable opportunity. I would assess market size, customer validation, competition, pricing, regulatory requirements, and the company's competitive advantage. Financially, I would model investment needs, ramp-up timing, margins, working capital, and downside scenarios. I would also test whether management has the people and systems to operate across markets. Funding should be staged around measurable milestones, protecting liquidity if adoption is slower than expected. Discuss market size, customer demand, competitive advantage, regulatory and execution risks, investment requirements, management capacity, milestones, scenario analysis, and whether the expansion strengthens or stretches the existing business. Question 10. How would you handle a borrower whose performance is deteriorating? I would act early rather than wait for a missed payment. I would review cash forecasts, covenant headroom, receivables, inventory, and the operational cause of deterioration. Then I would speak directly with management, validate assumptions, and agree on a credible action plan with milestones. Possible solutions might include revised amortization, additional equity, asset sales, or advisory support, but only if repayment remains realistic. I would document the analysis, escalate appropriately, and protect BDC's capital. Mention early warning indicators, prompt communication, root cause analysis, updated forecasts, covenant review, realistic restructuring options, documentation, escalation, and balancing client support with protection of BDC's capital. Question 11. What risks are particularly important when lending to SMEs? SMEs can carry concentrated risks that are less visible in headline financial statements. I would examine dependence on one owner, customer, supplier, or contract, limited management depth, weak reporting controls, cyclical demand, liquidity pressure, and succession issues. I would also consider fraud and personal guarantees where relevant. Mitigants could include covenants, reporting requirements, staged funding, insurance, diversification plans, or advisory support. Collateral is useful, but repayment capacity and business resilience remain central. Be sure to cover key person dependence, customer and supplier concentration, limited liquidity, weak controls, cyclical industries, refinancing risk, succession, fraud, and the importance of mitigants rather than assuming collateral solves every issue. Question 12. When would you recommend debt versus equity or venture capital financing? I would recommend debt when cash flows are reasonably predictable, the company can service payments, and leverage remains appropriate. Equity or venture capital is more suitable when growth is rapid, cash flows are uncertain, and preserving liquidity matters more than avoiding dilution. I would also consider the company's stage, collateral, strategic needs, and investor value beyond capital. The financing choice should match risk and duration. Forcing debt onto an early-stage company can restrict growth and increase failure risk. Explain alignment with cash flow predictability, growth rate, collateral, dilution, repayment ability, risk, ownership expectations, and the company's stage, particularly for innovative businesses with uncertain timing to profitability. Question 13. How would you identify aggressive assumptions in a borrower's forecast? I would bridge the forecast from historical results and challenge each major driver. For revenue, I would examine signed contracts, pipeline conversion, customer retention, pricing, and capacity. For margins, I would test whether claimed efficiencies have an operational basis. I would separately model working capital, seasonality, taxes, capital expenditures, and debt service. I would compare the plan with industry benchmarks and create base, downside, and severe cases. The quality of management's responses is itself an important risk indicator. Focus on comparing forecasts with history, industry benchmarks, pipeline evidence, pricing and volume assumptions, margin expansion, working capital, seasonality, sensitivity cases, and management's response to challenge. Question 14. What role does collateral play in a BDC lending decision? Collateral is a secondary source of repayment, not a substitute for a viable business. I would assess its value, liquidity, ownership, priority, enforceability, and potential realization costs. Equipment or receivables may provide meaningful protection, while specialized assets can be difficult to sell. I would also consider guarantees and insurance where appropriate. The primary question remains whether normalized cash flow can service debt. Strong collateral may reduce loss severity, but it should not justify an unsustainable loan. Clarify that collateral reduces loss severity but does not replace repayment capacity, and discuss valuation, liquidity, priority, enforceability, guarantees, monitoring, and the difference between secured protection and a viable business model. Question 15. How would rising interest rates affect a BDC borrower? Higher rates can affect a borrower through increased interest expense, weaker customer demand, lower investment, and more difficult refinancing. I would quantify the effect on cash flow, interest coverage, DSCR, and covenant headroom under several rate scenarios. I would then discuss mitigation, such as fixed-rate debt, hedging, longer maturities, pricing changes, cost control, or a liquidity buffer. The best response is proactive. Identify vulnerable borrowers early and adjust plans before pressure becomes a default. Discuss variable rate debt, interest coverage, refinancing, customer demand, valuation, investment decisions, sensitivity analysis, hedging, liquidity buffers, and proactive communication before rate pressure becomes a covenant issue. Question 16. Tell me about a time you explained complex financial information to a non-financial stakeholder. In a previous role, I explained a cash flow variance to an operations manager who did not work with financial reports. Instead of presenting accounting terminology, I used a simple bridge showing sales timing, inventory purchases, and supplier payments. I connected each item to an operational action and checked understanding through questions. The manager adjusted purchasing timing, improving cash visibility in the next reporting cycle. That experience taught me to tailor communication while preserving the underlying financial logic. Use a concise star example, explain the audience and complexity, show how you simplified without losing accuracy, describe the decision enabled, and quantify the result where possible. Question 17. Describe a time you had to make a recommendation with incomplete information. When information is incomplete, I separate facts, assumptions, and unknowns before recommending action. In one project, a deadline required a preliminary investment analysis before all customer data was available. I used conservative assumptions, triangulated available evidence, ran sensitivities, and clearly flagged what would change the conclusion. I also proposed a follow-up information plan and decision trigger. This allowed management to move forward responsibly without presenting a false level of precision. Highlight the decision context, critical unknowns, assumptions, risk assessment, information prioritization, consultation, recommendation, and how you monitored or adjusted the outcome afterward. Question 18. Tell me about a time you faced an ethical dilemma. I once noticed that a reporting adjustment made a performance result appear stronger than the underlying evidence supported. I verified the source data, documented the issue, and raised it privately with my manager rather than making an accusation. When the concern remained unresolved, I followed the appropriate escalation process. The final report was corrected, and controls were strengthened. I believe trust is a financial asset. Short-term presentation should never override accurate reporting or responsible decision-making. Demonstrate integrity, willingness to challenge pressure, factual documentation, confidentiality, escalation through proper channels, and a decision that protects stakeholders and the organization's long-term reputation. Question 19. How do you prioritize competing tasks when supporting multiple clients or transactions? I prioritize by combining urgency, risk, deadline, and business impact. A funding condition affecting a client's immediate liquidity would come before a routine analysis, while a high-risk issue would be escalated early. I maintain a visible task list, identify dependencies, block time for concentrated work, and communicate realistic timelines when priorities conflict. I also protect review time because speed without accuracy creates rework. If priorities remain unclear, I ask my manager to align them rather than guessing. Mention urgency, risk, deadlines, client impact, dependencies, transparent communication, structured tracking, escalation, and maintaining quality rather than treating every request as equally important. Question 20. How should BDC balance financial performance with its economic development mandate? BDC should pursue sustainable financial performance while deliberately serving entrepreneurs and markets that may be underserved by conventional lenders. That means assessing additionality, job creation, innovation, productivity, regional development, and inclusion alongside credit risk and expected returns. Public capital still requires disciplined underwriting because losses reduce future capacity to help businesses. In my view, the strongest approach is not choosing impact over performance. It is structuring viable investments where responsible financing creates both economic outcomes and durable financial value. Discuss sustainable risk-adjusted returns, additionality, underserved entrepreneurs, economic outcomes, responsible stewardship of public capital, measurement, inclusion, and why impact and financial discipline should reinforce each other. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.